Hi, and welcome to Yaeger CPA Review. We are here today with our resident regulation expert, Phil Yaeger, and he will be discussing some of the changes that you can expect to see on the CPA exam coming in Q1 2019. And we know that this is a topic that a lot of you are a little bit worried about, so we'll be doing a series of these recordings so that we can prepare you to the best of our ability so that you can go in and ace that exam. All right, passing it over to you, Phil.
Thank you, Megan. Now, the changes I'm going to talk about in the tax laws, and by the way, these changes also affect some other areas of regulation, of which I will mention at probably the next class. I talk about the Tax Cuts Act. But I'm going to refer to the act as the Trump Tax Act, even though it's called the Tax Cuts and Jobs Act. Let me just call it Trump's Tax Act. And it'll start being tested on the exam in the first quarter of 2019, and that is January 1st or 2nd, depending upon, I don't know if the exam centers are open January 1st, but January 2nd of 2019. And unfortunately, there were a lot of changes. This Tax Act was probably, more complicated than the original Total Act, which changed everything, which was the Tax Reform Act of 1986. So I'll talk about this. I'll try to make it as clear as possible. And then if you have any questions, Megan will tell you how you can get a hold of me, and then I'll answer any questions you may have. But just listen and play this back a few times if it helps you. The first thing we're going to talk about are the individual changes. Now, first of all, we're going to see as we go through this that a lot of deductions have been eliminated. And therefore, a lot more of the taxpayers out there will be taking the standard deduction. So the Trump Act has increased the standard deduction for filing, for 2018. Now, let me explain. The Tax Cuts Act doesn't go into effect, or the Trump Act doesn't go into effect January of 2019, the actual act itself. The actual act applies to tax years beginning January 1st of 2018. So in 2019, you're going to be preparing 2018 returns. So that's when these tax cuts, these changes will actually occur. So let me go back here again. We're going to see that in 2018, a lot of itemized deductions, the personal exemptions for yourself and actually your children will be actually adjusted and sometimes eliminated. So a lot more people will be taking the standard deduction. So because of the major changes with the itemized deductions, the standard deduction, because I feel more people will be taking it in 2018, the standard deduction has been increased to $24,000 for individuals married filing joint, and it'll be $18,000 for head of households, and also it'll be $12,000 for all other taxpayers, such as single, unmarried widow or widower with dependent spouse. That should be the situation. Now, let's look at some other things here. And this was a major draw, which a lot of people are going to say, oh my God, I have a lot of children. And I used to get someone like a $4,000 exemption deduction for them. And also for myself. Well, the personal exemptions, have been suspended or repealed. So therefore, the deduction for personal exemptions is effectively eliminated, and goes down to zero. Now, the thing with the individual portion of the Tax Cuts and Jobs Act, Trump's Act, is that these changes expire after 2025. Let me repeat that. The business provisions for corporations, they are not going to actually expire. That's the big complaint about many people who don't like this act. But for individuals, the individual provisions will expire in 2025. Now, hopefully you won't be taking the exam after 2025. Now, the next thing we'll talk about that has actually changed as I turn my pages here is, the Kiddie tax. Now, the Kiddie tax has been modified. And this is what it says. Under the Tax Cuts and Jobs Act, the child's tax will no longer be affected by the tax situation of the child's parent or the unearned income of any siblings. So children who have unearned income will tax rates for estate and trust ordinary and capital gain rates. All right, which means we'll apply the estate and trust rates under the Kiddie tax rules, which will produce a higher tax bill because the income ranges under the new Kiddie tax schedule are much smaller than those for individuals. All right, so because this change, that the unearned income of a child, the Kiddie tax, all right, will be taxed at the estate and trust. This is going to give the government higher taxes. So however you slice it, all right, the individuals are probably going to end up paying higher taxes than they did before. All right, now let's talk about, all right, other things here, which are the deduction for personal casualty and theft losses. Now, individual casualty and theft losses were an itemized deduction, and there was a $100 reduction of whatever your casualty loss was, all right, and then you deducted 10% of AGI. Well, guess what? All right, they have gotten rid of the personal casualty and theft loss deduction. It's been suspended, all right, for tax year beginning 2018, except they still allow deductions for personal casualty losses incurred in a federally declared disaster. All right. Now, as I sit here today, Hurricane Florence is supposed to hit the Carolina coast. Now, we hope they won't have a major casualty losses to the people who live in the Carolinas, but that will be declared probably a federal disaster. So in that case, I don't know, you say this is the good thing about it. It isn't. But those personal casualty losses, all right, for those individuals in federally disaster areas will still have to be deducted as an itemized deductions. All right. And the loss, all right, will be subject to the $100 per casualty and the 10% of AGI limitations. Now, one other thing. If you have a casualty gain, all right, you're an individual taxpayer and you have a casualty gain, you can deduct casualty losses up to casualty gains. So now, other than federally disaster areas, all right, you can deduct personal casualty losses. If you have casualty gains, the personal casualty losses cannot be deducted in excess of casualty gains. All right, now, the next thing is, all right, we're going to talk about changes having to do with gambling losses. All right, now remember, under the old act, gambling losses, all right, were limited to gambling winnings. But now the act provides that the limitation of wagering losses is modified to provide that all deductions for expenses incurred in carrying out wagering transactions and not just gambling losses are limited to the extent of gambling winnings. All right, so now any costs having to do with the wagering transactions, all right, involved with, the cost of wagering, also that includes wagering losses, all right, it says you can deduct against gambling losses all costs and expenses in carrying out wager transactions. All right, now moving on here, the child tax credit, which deals with individuals, that has been increased under the Trump's Act, all right, to $2,000. And remember, before the act, the maximum you could claim was $1,000 for a child under the age of 17. But the Trump Act modifies the child tax credit by increasing the credit amount to $2,000. All right, but the income levels in which the credit phased out are increased. All right, so therefore, here's a nice little benefit. All right, for every child you have under the age of 17, you will now get a $2,000 tax credit. All right, now this is not the unearned tax credit. This is not the child care expense credit. All right, it's none of that thing. It is a child tax credit for just having a child under the age of 17. For the new Trump Act, it's up to what? $2,000. And, all right, the phase out amounts, which means, remember, a lot of these credit deductions are phased out if your AGI exceeds certain limits. Well, the AGI income phase outs for the child tax credit has been increased. And by the way, do not worry, all right, if they give you phase out amounts someplace. Because remember, the exam does not test phase outs. Please remember that. And the reason they don't test phase outs is because they generally change each year. Now, another change in the child tax credit is that of the credit, all right, there's a $500 non-refundable credit provided for certain non-child dependents. All right. Now, what does that mean? A portion of the $2,000 is a non-refundable credit, which means that tax credits only benefit you if you owe money to the government. But now they're saying, all right, you can take as a non-refundable credit up to $500 per child, which means you can get back $500 even if you don't owe the government any taxes. That's been a major change. All right, and the next thing is state and local tax deduction. Now, it used to be that state and local taxes, which is basically real estate taxes, whether it's in the United States on a property owned here or a property owned in a foreign country, those real estate taxes were deductible in full. Also, if you have state income taxes that are taken out of your salary because you're in a state that pays state income taxes, you have to pay state income taxes on your earnings. All right, that was also part of the state and local taxes. And also, what was part of the state and local taxes were foreign taxes paid. Now, please remember, there was no limit on how much you could deduct for that. But the Trump Act says, starting in 2018, all right, a taxpayer can only claim as an itemized deduction up to $10,000, except $5,000 for married filing separately, all right, to the aggregate of, the total of state and local taxes, all right, state and local income taxes, all right, and foreign real estate taxes may not be deducted under the $10,000 aggregate rule. So I'm going to make it very simple for you. All right. What is now limited is this: real estate taxes for property you have in the United States. If you have a primary residence, you have a secondary residence, all right, you take those real estate taxes, you add to that your state and local income taxes withheld, and the total cannot exceed $10,000. All right. Now, also, once again, that rule will expire, all right, after 2025. Now, here's another change. All right. The mortgage interest acquisition debt maximum is now lowered to a maximum debt for acquisition indebtedness, all right, for $750,000. All right. And also, the deduction for a home equity interest is been eliminated. So you can only deduct interest on acquisition indebtedness. That means that any debt you incur to acquire your home, all right, but home equity loan interest is no longer deductible. It's been eliminated. And one other change, when it came to acquisition indebtedness, the maximum loans you could have on your primary residence, secondary residence, was a maximum loan of $1 million. But now, effective in 2018, the maximum loan on these acquisition indebtedness or acquisition debts is a limit of $750,000. All right, please remember that. And taxpayers may claim an itemized deduction for qualified residence interest. We just discussed that. But remember, the interest is not limited. It's the what? The amount of the acquisition indebtedness that is now limited to $750,000. That's the maximum you can calculate your interest on the qualified residence interest. All right. Now, moving on. The medical expense deduction. Now, the medical expense deduction is still an itemized deduction, and you take all of your medical, unreimbursed medical expenses, and they must exceed the 2018 7.5% of AGI, all right? And please remember that it's going to stay like that, but probably for 2019, it'll go up to 10% of AGI. But don't worry about 2019. We're talking about 2018. So you can take your unreimbursed medical expenses, same as they were before, and they have to exceed 7.5% of AGI for 2018. All right. Now, there are limitations on deductions for charitable contributions, but they have been increased. Now remember, the maximum charitable contributions you can deduct on your return, all right, for all contributions, cash, property, was limited to 50% of AGI. All charitable contributions were limited to 50% of AGI, but now the limit has gone up to 60% of AGI. That's the good news. And, all right, please remember that with that limit, all right, we still have, first of all, we have the, let me see, you can still, all right, whatever you can't deduct in excess of the limit, you can carry forward up to 5 years. All right, now the 30% is still in there. So remember, when you're trying to determine that 50% limit for all contributions, always deduct your 30% limit charitable contributions and then take your 60%. So what it's saying is, overall, your contributions cannot exceed 60% of AGI. That's a change. Now, there are basically two types they ask on the exam: the 30% contributions and the 50%, I'm sorry, the 60%. Now, the 30% would be like, for example, appreciated long-term capital gain property. Now, if you give that to a charity, all right, you can deduct its fair market value, but it's limited to what? 30% of AGI. All right, so you take all this 30% first. All right, now you know what your overall limit's going to be. You take 60% of AGI. You've taken your deductions for the 30% charities. Now you're going to take your deduction for the 60% charities. The 60% charities is where you give cash to a church. That used to be a 50% limit. Now that's a 60%. But before you deduct that 60% amount for cash, make sure the cash contribution plus the 30% charities, when total, do not exceed an overall of 60% of AGI. And here's one that's no longer deductible. All right. We had a deduction for alimony. All right. So if you paid alimony to your former loving spouse, all right, you can deduct those alimony deductions to arrive at AGI. But alimony, starting in 2018, is no longer deductible. It's no longer deductible. Please remember that. It's no longer deductible. And therefore, the alimony income to the recipient is no longer taxable. All right, there's a change. Now, that deals with giving cash alimony. All right, if you give away property, property was never alimony. Remember that. Property in a divorce is never alimony. It's not taxable. It's not deductible. It never was. All right, now, child support is still the same. Child support payments are not deductible, and they're not taxable income. Now, I think you've had enough. What do you think? Megan, is that enough for today? Megan, are you there?
I am. I think that that is a good amount for people to kind of dive into this. You can tell that there are a lot.
There's still more individual, all right? Boy, I'll tell you something. This act, because I researched all these provisions in detail before I rewrote the book. And by the way, I am proud to say our 2019 book has all the new blueprints, all right? If there are any new blueprints. And remember, our books are this. We give you the blueprint, and we give you all the information having to do with that blueprint underneath. And I'll say it again. Other courses may give you the blueprints, but they don't have the text that deals with that blueprint necessarily under the blueprint, all right? We write specifically for the blueprint, all right? And that means, to clarify what that means, is this. We give every blueprint, and then under a blueprint, we discuss exactly, all right, what information you have to know under that blueprint. Now, if you want to know if those topics are going to be actually given as multiple choice or simulations, if you go to the AICPA.org website, you can print out the actual, all right, blueprints. And they will give you columns. And I think if it's multiple choice, it's called understanding. Is that correct, Megan?
Yeah, it's called remembering and understanding.
All right, and that will be tested as just multiple choice. And if it is a simulation, how do they say it's under what column, Megan?
Typically, it's under analysis. There's an application column that could go either way. So it may be multiple choice and it may be simulations. In audit only, there's an evaluation column. None of the other sections test at the level of evaluation, but those most likely will be task-based simulations on audit also.
All right, and now they're going to give you different documents. You know, they'll give you situations and they'll give you documents. Oh, you maybe 3 documents. You know, they might give you the taxpayer's income statement. All right, they might give you some memos. All right, emails, and based on that, they're going to ask you questions on it. Those would be the task-based simulations. Now, that is not really the way it is in the real world. I can tell you that because I did tax returns and I still do tax returns. And I don't say to my client, hey, Bill, just bring me 3 documents having to do with that thing. In fact, you bring me the right documents. No, when I used to do a tax return, all right, the clients would give me everything and I'd have to take out the information that I needed to prepare their individual, their corporate, C Corps, S Corps, etc. All right, now, if you want examples of task-based simulations, and those are real examples, not the one the other companies give you, all right, which are nothing more than author-constructed simulations, but you want to see actual, go to the AICPA.org website, and they have task-based simulations, examples for every part of the exam, all right? Now, I can tell you this, all right? They are actually much harder than the ones they'll give you on exam because a lot of those have been actually, they're originally, I would say, questions that were called, you know, they throw them out. What did they call that, Megan? I'm sorry, I can't think of it.
Pre-test questions. So every test question that gets onto the CPA exam goes through a process of pre-testing. So candidates will take it, not know it's a pre-test question, but then they have enough information to gauge whether or not a typical CPA candidate would be able to answer that question if they've passed the exam on the other questions. So they look for something that will be valid with the other questions that they're asking. So
when do they release those questions, Megan?
Yeah, so they'll release a set of questions to us every April. And so we get those written up with answer explanations and posted for our students and incorporated into our software as soon as possible once we get those.
Megan, can you come closer to the microphone?
Yes. And yeah, so, but I wanted to recap. If you wanted to get a hold of us, if you have more questions about the CPA exam in general or on regulation, the topic that we discussed today with Dr. Phil Yaeger, you can get a hold of us.
Call me Dr. Phil. That's the guy on TV.
That's
right?
it.
I'm going to you, the students.
And so you can find us at YaegerCPAReview.com. Remember, Yaeger is spelled A-E-Y-A-E. CPAReview.com, or you can call us and speak with our customer support specialist, Sunny, at 301-874-4900. And if you have specific questions to speak with Phil about regarding these changes or anything else, you can reach him at extension 5. And we look forward to working with you. We hope that you have found this information valuable. All right.
And next time, we'll continue on with the individual deductions, all right? And then, by the way, if you really want to find out what these are, okay, all right, you could go on a Google search, all right, and put in Tax Cuts and Jobs Act, and they will take you to a lot of good websites which will list all of these changes, all right? Now, sometimes they explain them fairly well, sometimes they don't. But I'm going to try to do this. I'm going to tell you what they are and try to explain them to you in simple English. Okay? All right, ladies and gentlemen, thank you very much. And Megan, thank you very much for actually running this thing. And we'll see you, we'll announce sometime, it'll be sometime next week, when we will have this second webinar on the changes in the taxes, and also the changes in, there's some changes in multi-jurisdictional, and also the change in the what's Obama's Act, the Health Care Act. All right, there's changes in that. Am I correct, Megan?
Correct. The Affordable Care Act, there will be
Affordable
changes.
Care Act, and we'll talk about those also. All right, take care, everyone. Good luck. And by the way, if you got your results, don't be down. All right, just pick yourself up and start studying again, or give me a call. I'll discuss it with you. Take care, everyone, and thank you again for watching our webinar.